There was a house price bubble, I would say. There has been a sort of subprime crisis. Do you see another bubble on the way?
Not in house prices, for sure, although I think what we're seeing in house prices now is a downward spiral of house prices because we have very high loan-to-value ratios. People are defaulting on their mortgages, and that's leading the banks to foreclose and to sell that property, and that's driving house prices down. The thing that worries me, or would worry me most as an investor in existing asset prices, is long-term bonds. I think there's a real risk that interest rates on long-term bonds will go up in response to fears about inflation and fears about fiscal deficits, and so if interest rates go up, the price of those bonds comes down.
Looking at the dollar, what do you think of it as a global reserve currency and also just as an investment play for foreign investors?
Well, the dollar, I think, is going to be coming down. Not dramatically, not overnight, but over the next few years, I think the dollar will be more competitive against the euro, against the Chinese renminbi, probably against some of the other Asian currencies, because we have an enormous trade deficit now in the United States, and with the price of oil coming back up, that trade deficit's going to get larger, and so we're going to see even more pressure on the dollar. I think foreign governments, we're no longer talking about reserves. When you get to $200, $400 billion or $1 trillion plus in the case of China, these are not reserves in the old sense of having liquidity there to help you get through temporary fluctuations in your imports and exports. These are big investment portfolios. They run very large surpluses. They've accumulated a lot of foreign wealth, and the question is, how do they hold it? And the initial position was to hold it in dollars, but now they're diversifying and moving toward more in euros and more in other currencies. And I think we'll see more of that going forward. And they don't want to come right out and say that because doing that would put downward pressure faster on the dollar. They'd like to do the deal first and talk about it afterwards.
Okay. If we look at markets, and economic growth, you're concerned that a lot of the stimulus from the Obama package is going to come to an end at the end of next year, and that could spell bad news for equities.
Yes, it could spell bad news for equities even before that. That is, I think what we're seeing now is we hear all this talk about green shoots and things getting better, and I think there's some reality behind that, and the reality is that in this quarter of the year, in the second quarter of the year, the fiscal stimulus, the tax cuts, and the increased government spending has been turned on. And we're going to get about an extra 1% of GDP out of that, and probably by the next quarter, we'll have gotten it up to its maximum run rate of about 2% of GDP. So that'll give a bounce to GDP, or it'll take away some of the downward drag in GDP and get us back closer to a zero growth rate rather than a minus growth rate that we've had in the last couple of quarters. But it doesn't continue unless something else changes. So there's a real risk that after a couple of quarters, long before you get to the end of 2010, there's a real risk that the economy will go back to sliding at a faster pace. And if that happens, I think equity markets are going to be disappointed.
You were chief economic advisor to President Reagan. Under his regime, the fiscal deficit never got worse than 6%. This year it's projected to be round about 12% and remain extremely large for the foreseeable future. What do you think about that?
We worried about it a lot when I worked for President Reagan. We were very eager to get that deficit down. In fact, it did come down through a combination of spending cuts and some increases in taxes. But the worrisome thing now is that the Obama administration are projecting deficits that will stay over 5% for 10 years. So that between now and 10 years from now, if there aren't changes in the programs that the president has proposed, we will see the national debt go from 40% of GDP to 80% of GDP. And 10 years out, we will still have deficits on an annual basis that are as large as the largest that we had in the Reagan administration. And there's a further aspect to that. One of the reasons for the high deficits in the early part of the Reagan years was that the economy was in a serious recession. So tax revenue was reduced and various transfer payments were up. When you look out 10 years from now, we're talking about forecasting into a full employment economy in which none of those problems are there. So it is an even worse deficit at 5+% 10 years from now than it was in the early Reagan years when it was, to a significant extent, a cyclical deficit.
Obama is planning to raise taxes. What do you think about that?
Well, I think the Obama plans for raising taxes are a mistake. He's going to raise taxes on high-income individuals. He's going to raise taxes on dividends and capital gains. He's going to raise taxes on businesses with overseas incomes. He's going to raise taxes on the general public through the cap-and-trade system of carbon taxes. So there's a lot of tax increasing going on. Now, what they say is these tax increases won't take effect until 2011, and therefore they're not going to hurt the recovery. I think that's a mistake for two reasons. We don't know where the economy is going to be in 2011. But even apart from that, people look ahead. Businesses look ahead. And so if you start putting that legislation in place in 2009, people aren't going to wait to 2011 to start making changes. And so I think that's going to hurt our recovery. And of course, the higher taxes long term will hurt the economy going forward.
Can I ask you about the proposed cap-and-trade carbon tax? This looks like America going green. True or false?
Well, the carbon tax, the cap-and-trade carbon tax, was originally proposed along European lines as an auction of permits, tradable permits. But there was so much pushback from members of Congress, from industrial states or coal-producing states, that they have fundamentally changed the program to one in which most of those permits are going to be given out to electricity companies, to coal producers, and others. So it's hard to know exactly how effective it is going to be in actually changing technology or getting households to change their demand for carbon-intensive products.
What do you think the effect of the cap-and-trade will be on trade generally?
I think it could have some very serious adverse effects because it's going to raise the prices of products that are carbon intensive, CO2 intensive. That's going to put, if we enact this legislation, that's going to put those producers in the United States at a disadvantage against foreign producers, particularly the Chinese, the Indians, and others, who will not have that extra tax built into the price of their products. Well, I was shocked to hear that the World Bank has said, therefore, perhaps there has to be border adjustments, taxes, tariffs, to offset that. Well, it's very hard to figure out how much the tax would have to be to just balance these things, but it will be an open invitation to all those who are looking to reduce trade, to protect domestic industries, to claim that, well, because of the higher price of electricity or the higher price of gasoline, they're at a great disadvantage, and so they need border protection. So I think this could open up a whole round of of adverse trade policies, of new tariffs.